Hello everyone. We are starting with fixed income, one of the longest topics that you have in your CFA level 1. Unfortunately, now you have 11 readings. These 11 readings together constitute around 11 to 14%. So on an average, you'll get around 20 to 25 questions, same as equity. Okay. So we have these 11 readings. We'll go step by step. Some of the readings are very short. They are just 1 pages. So we'll probably do a couple of readings and then do the questions together. Some of the readings are very lengthy also. Okay. So we'll go step by step. Do have patience because many of the small doubts will get covered up when we do the questions. Remember, it's a revision series. So I haven't covered each and every word from the book, from your original book. Okay. So we've covered everything in a concise manner. So many of the small doubts will get clear when I do the questions with you, right? Okay. The first 5 readings are generally theoretical except the calculation of repo. Okay. This calculation of repo is rarely asked, but we'll do a question. I've added some extra question related to that. Then the calculation actually starts when we do fixed income bond valuation price yield. From there, all the calculation starts till the credit risk. Okay. So let's begin with the first topic itself. Everyone in the class, the first topic is fixed income instrument features. Now, in this topic, you just have a very basic of fixed income, all the terms. That's it. Nothing else in this topic. Everything else will be covered in the other topic. Okay. So many of the terms, it's like a, it's like a warm up that we are doing. For example, in fixed income, the ones who are bond holders or lenders are investors. They are the ones who have bought the bond. Whereas issuers are the bond sellers. Those are the ones who need capital, right? So investors means lenders, issuer means borrowers. Borrowers are bond sellers, lenders are bond buyers, right? These issuers can include corporations, government, non-government, and supranational. We will discuss what is a supranational when it is or multi-country organization. Maturity can be less than 1 year, which are called money market instruments. More than 1 year are called capital market. And there are some bonds which are perpetual or called consols in UK. Coupon can be fixed, floating, or you can also have zero coupon bonds. Seniority, yes, when companies issue debt, it's in different levels. Seniority, the most senior ones are paid first, followed by the subordinate ones. We will also see some of the bonds which are very unique, like they have embedded option into it, which are callable, putable, and convertible bonds, right? They are the ones which can be converted or which have some features of being called back. Yield is the return on the bond. The IRR on the bond is called yield, right? When this yield is plotted with maturity, it's called yield curve. And generally the yield curve is upward moving, upward sloping. But in terms of crisis, in times of crisis, it is inverted. We'll discuss more about yield curve, I think, after a couple of more readings. Okay. Bond indenture. Bond is a contract between the bond holder and the bond issuer. Correct. So this contract, which has the rights and obligations, that is called bond indenture. Under this bond indenture, the issuer, which is the borrower has to follow some conditions or some conditions applied by the lender for the protection of the lender, right? These are called bond covenants. Covenants are conditions, right? Or clause. These covenants can be affirmative, negative. We'll discuss about that later on. Affirmative means something that the issuer has to follow, like maintaining some minimum amount of ratios. Negative are the restriction that the issuer should not do. For example, they should not increase the level of borrowing. They should not pay dividends before paying the interest, etc. Affirmative and negative. Now, different types of issuers. Sovereign means the national government, right? How do they get the sources? Or what are their sources of cash flow to repay? Well, they can tax the economy, right? They can tax or print currencies. Therefore, sovereign bonds are virtually risk-free. I'll repeat, sovereign bonds are risk-free. Non-sovereigns are those which are issued by, counties or some states, not the federal government, but the state government or some emirates. These have also the power of taxing in the local, but their major revenue might also come from infrastructure, from the facilities that they provide, the municipality, right? Those are the non-sovereign bonds. Companies, commercial companies, corporates, they issue bonds and their source of cash flows are various. So their cash flow depends on the different types of bond. Also, it depends whether the bond are secured or unsecured. Secured are safer because they have a collateral attached. Unsecured have a general claim. Asset-backed security, for this we will do a topic. The last couple of readings are based on securitization. So at that time we will discuss how the entire securitization process works. Here, the issuer of the securities will recover, or their source of cash is nothing but the pool of loan, that is pool of asset-backed securities. We'll discuss more about asset-backed securities later on. As of now, just focus on the terms. Well, your first reading is this. That's it, right? This is the only stuff in your first reading. So what I'll do is that I'll do the second reading also, and then we will club and do the questions together. Second reading is continuation of a lot of terms. Many of these terms, we need to get used to it because that's what they will be asked in the exam, okay? First of all, tell me, in a normal bond, which we are going to do calculation, right? A typical bond is the one, let's say a 5-year bond. 1, 2, 3, 4, and 5. A 5-year bond, imagine, is currently issued for some present value. On maturity, it will pay me the face value back. Am I correct? But every year, it will also pay me coupon. Coupon is nothing but the interest earned on the bond. These coupons are discounted at the YTM and we get the present value. Correct? Here, when am I going to pay the entire principal? Did you notice in this bond, when is the entire principal repaid? It is repaid in full amount on the maturity in one go, isn't it? This is a typical bond called as a plain vanilla bond where the entire principal is paid at one go on maturity. That's called a bullet bond, one shot. Most of the bonds are bullet bonds. Unless mentioned, they are all bullet bonds. Everyone with me on this? Correct? So most of the bonds issued are bullet bonds where the entire principal is paid at one go on the maturity. However, there are some bonds when you take mortgage, for example, when you borrow for your home loan or car loan, the amount that you pay at every installment not only includes the interest, but also some component of principals. So basically you pay principal and interest together. This periodic payment of principals and repayment of this periodic payment of interest and repayment of principal is called a fully amortizing loan, where at the end of the maturity, at maturity, that is at the last installment, your face value or your your principal value outstanding is zero because everything is paid. This is called a fully amortizing loan. It is generally in the case of mortgages. Bullet bond, everyone in the class, please reply on the chat box. Bullet bond, entire principal is paid on dash. Fully amortizing bond, entire principal is paid at the end, or it is paid in each installment. Some portion of the principal is paid on each installment. Am I clear, everyone? Correct. Between these two extremes is a partially amortizing bond where some portion of the principal, some portion is paid before maturity, but major chunk or major proportion of the principal outstanding is paid at the end. So that's like a balloon payment. Balloon means, see, you're paying some principal, but major chunk is paid at the end. So it's like a balloon. That's called a balloon payment. This is between bullet and fully amortizing. Hence, it's called partially amortizing bond. Is this clear? Correct? Understood? Now, what is sinking fund arrangement? Sinking fund arrangement is also amortizing, but here the amortization is dependent on a plan, an agreement between the issuer and the lender, is where the issuer will redeem some fixed proportion of the debt each year. some fixed proportion of principal each year, right? So every year, some of the principal will be redeemed as per the plan. Now, because of this, when the maturity comes closer, not a huge amount, but only a small proportion of outstanding is left. So sinking fund is a very systematic and a planned version of repayment. Okay, it's not in partial, it's neither fully amortizing, it's a systematic way of repaying the debt. Okay, sinking fund are said to be more secured for the lender because they have a plan at place and every year some amount is repaid. This is what we discussed about the principal repayment. What about the coupon? In coupon, the name itself is the answer. Okay. Generally, in a plain vanilla bond, the coupon is fixed or floating. Coupon, the periodic payment is fixed. In a floating rate bond, the coupon is based on some reference rate. That reference rate is called MRR, market reference rate, MRR, market reference rate. In the past, it was called as LIBOR, market reference rate. So as the MRR, benchmark rate, increases, the coupon will also increase. As the benchmark decreases, coupon will also decrease. But we will ensure that it doesn't go unlimited on the upside or downside. So there might be a cap on maximum increase or floor on a maximum decrease. I'll repeat. There will be a cap on and floor. Cap means it will not go beyond this point. Floor means it will not go below this point. This is done in a floating rate note. So in a floating rate note, as the reference rate increases, I will get more coupon, less coupon. I'll get more coupon. I am betting or I'm expecting interest rates to increase. But if you're expecting interest rates to decrease, you can invest in an inverse floater. Inverse floater is exactly opposite to floater, where you will get more coupon when the yield, when the market interest rate goes down. So I've given an example, 12 minus LIBOR. So as the LIBOR increases, your coupon will be less. But as the LIBOR or market reference rate, instead of LIBOR, you can use market reference rate. As it decreases, your coupon will increase, opposite to floater. Clear? Step up coupon, step up, step up. Step up works like this. So for the first 2 years, there might be 2%, then the next 2 year, it might be 4%, then the next 2 year, it might be 5%. So in step up coupon, the coupon increases, but in phase or in stages. That's why it's called step up. Gradually it increases. Okay. Then comes a very interesting coupon method, which is called credit link coupon. For example, if you expect a company's credit rating to downgrade, then you will be compensated with more coupon. Yes. If the credit rating goes below some minimum decided rate, then the bond becomes riskier and then you get more coupon. So credit link coupon note is one type of your risk management activity, where if you're worried that the bonds value will go down because it's becoming more riskier, then you can invest in a credit link coupon bonds where you will get more coupon if the credit rating of the company deteriorates. Okay, understood? Now, in many cases in Europe, there are some unique types of bonds which are called as PIK bonds, payment in kind bonds. Well, what is the situation here? Suppose if the issuer finds it difficult to repay the interest. Therefore, in such a case, instead of paying the interest in cash, the issuer will pay the interest by issuing in kind. In kind means they will issue more bonds. So it's basically borrowing on the interest also. Correct? So here, what will happen if the issuer is unable to pay the interest in cash? The issuer will have to issue more bonds. This will lead to the new bond that is issued because of being unable to pay interest is generally higher because now the companies become more riskier. This is called payment in kind, when the company is unable to pay the interest in cash. In some cases, when you have borrowed money, but you cannot immediately generate the cash flow because the project takes multiple years to complete, or there is heavy investment before the revenue begins. And this investment can last for a couple of years. So in such a case, you are not in a position to repay the interest back immediately. Therefore, you issue a deferred coupon bonds. In deferred coupon, let's say for the initial couple of years, there will be no coupon. So there will be zero coupon, and then you probably might get more coupon. So your coupon payment are deferred, right? It's also called split coupon bond, where no coupons are paid in the initial few years, and then a higher coupon is paid in the later part. This is very common in project financing, especially when the projects are for multiple years. Now, very interesting and a new thing is called green bonds. Remember, many countries have these days issued green bonds to fulfill their ESG criteria to meet the 2050 zero emission targets, right? But by issuing green bonds, they have an obligation that they have to meet. If the chances of them meeting the obligations are less, okay, then it's a risk, isn't it? Then I should get more coupon. So it's a protection against such a risk. So what is green bonds? Here the coupon rate increases if the environmental goals are not met by the issuer by the deadline, that is by the time. Environmental goal can be reduction in carbon emissions, etc. So if you think that the issuer will not be able to meet the goal that they've committed to, then the coupon rate will increase. Such bonds are called green bonds. Clear? Then you have index linked bonds. These are like floaters, but here your coupons are based on some specific index, which can be inflation, earnings of a company, commodity prices like gold, currencies, etc. Of the index linked bonds, the most famous is inflation linked bonds, where those who want to seek protection against the rising interest rate, they can invest in such a bond. They will protect hedging against inflation. Why? Because as the inflation increases, my bonds cash inflow will also increase. These are very famous in US, okay, and they are based on the consumer price index, CPI index, which we have in economics, the consumer price index inflation. So as the inflation increases, the coupon payment or the principal payment or both will increase. Okay. This inflation index bonds in US are also called linkers. These linkers have variety, as I said. In some cases, as the inflation increases, only the principal will increase. And in some cases, only the coupon payment will increase. So if only the principal increases, it's called zero coupon index bonds. Only the principal changes because of inflation, then it's called zero coupon index bond. So you get protection only for the principal. But if you want only the protection in the form of coupon, for the coupon, then you invest in interest index bonds. All of these are linkers, okay? Variety of linkers. However, you might need protection against both, right? That means as the inflation increases, you want the principal also to increase, outstanding, so you get more money, and you also want coupon to increase. So a security which takes care of both is called US TIPS. Treasury inflation protected securities, very famous security. It's also called capital index bonds. Here, both interest and principal payment both will increase or be adjusted with inflation. The US TIPS is one of the most sold securities in terms of inflation protection, and they take the reference of US CPI. Correct? So if you want complete protection against inflation rise, you better invest in US TIPS. Clear? Okay. Then we have bonds with contingency provision. This we are going to discuss when we do the calculation in bond valuation. Two types of bonds, callable and putable. As of now, remember, callable bonds gives the right to call back the bond. To whom? To the issuer. So the issuer, here the issuer benefits because the issuer has a right to redeem or call back the bond. And this is generally done to protect against what? Against declining the interest rate. So if there are interest rates declining, the issuer might want to reissue the cheaper bond. So callable bonds give the right to the issuer to call back the bond. Putable bond gives the right to the investors or bondholders to dump or sell the bond before it starts falling, okay, at a fixed price. So callable bond for the issuer, putable bond for the investor or bondholder. As of now, just remember this. Got it? Convertible bonds, we've already covered convertible bonds when we did the calculation of EPS in income financial statement. These are bonds which are before conversion, they act like a typical bond, but after conversion, you get equities. Okay. Now, here, do you remember the conversion ratio? Conversion ratio basically tells you how many common equity you will get for each bond. How many number of common shares you will get for each bond. But how is conversion ratio derived? It is derived from the conversion price. Yes, from the conversion price. And what is conversion price? It is the price per share at which the convertible bond can be converted into shares. For example, suppose the par value of the bond is 1000 and the conversion ratio is, let's say, 25. Conversion ratio is 25 is to 1. Means for each bond, how many common shares you will get on conversion? 25. So guys, my par value is 1000 and my conversion ratio, par value divided by the conversion ratio is 25. So my conversion price, if you calculate this 1000 divided by 25, that will be 40. So as the market price of the share goes to 40, the bond will become convertible. Understood? Clear? 25 is my conversion ratio, 1000 is the market price or the face value of the bond. As the price of the stock hits 40, the bond will become conversion and I will get how many shares against each bond in this example? I'll get how many shares for each bond? Everyone in the class? Check on the screen. How many? 25, right? That's my conversion ratio. But imagine after you convert, the market price of the shares, of the equity shares, not the bond, the market price of the equity shares turns out to be 50. And how many shares did you get on conversion? 100. So this 5000 is nothing but your conversion value. What is conversion value? It's the current share price multiplied by the conversion ratio. This value, higher the value, the better it is. Okay, so you invest in a convertible bond with the hope that your conversion value will be increasing and much higher. Clear these three things? Conversion price is the price at which the bond will be converted and how many shares you will get. That is what is the conversion ratio. So those number of shares into the current market price is your conversion value, the value that you receive if you convert and if the market prices goes up. Everyone with me on this? Clear? Now, in the calculation of EPS, we did understand options and warrants, which were similar, but in reality, warrants are different. Warrants are also an options, but they are sold along with the bond. So they give the bondholder, they are attached with the bond. So the one who has the warrant, they have the right to buy the share. They have the right to buy the share at a fixed price in the future. So warrant entitles the holder to buy the share at a fixed exercise price before the expiration. Correct? So now here I have got the right, but of course it's not sure that whether I will exercise or not. I buy this warrant, I can get it along with the bond also. It is attached or it can be detached. You can separately buy the warrant also, right? However, why are warrants attached to the bond? See, if there are two bonds in the market with exact same feature, which one will people buy? The one which has warrant because it has some extra feature. Okay. So warrants make the sellability of the bond much easier. Therefore, they are called sweetener. Warrants, when attached to the bond, they make the bond sweet to sell. That's why they are called sweetener. Okay. They are actively traded in many of the financial markets. So warrants have a very highly liquid market like stocks. Got it? Now, convertible bonds get converted when the company's share price performs high. Okay. Contrary to that are contingent convertibles called CoCos. Again, these are very famous in Europe. CoCos. So imagine if a company is unable to pay back the money, right? If the company is unable to repay the bond, in this case, when the bonds with contingent write-down provisions are converted on the downside. So here, if the company is unable to pay the bond back, the principal back, then these bonds are automatically converted into common shares. So basically equity shareholders take control of the company. This is compulsory for many European banks. So several European banks have issued CoCos. The regulations have made it quite complex, and they made it very stringent for companies that if they do not pay the bondholders, then their outstanding will be converted into common stock and they will lose the control. So here the conversion happens when the security is not performing compared to a normal convertible bonds. So here the conversion is automatic if a specific event occurs, right? Especially if the bank's capital falls below the minimum required by the regulators. So this is very famous for banks, and hence they must offer a higher yield than the otherwise similar bonds. CoCos are very risky, right? Of course, people who buy CoCos, they know that there is a chance that the company might not be able to pay the bonds back. And in that case, you will get equity. So they are highly risky. People will only invest if they get a high yield. Clear? Now let us understand the legal and regulatory structure. Suppose a company issues bond in the local currency and in the domestic country itself, then it's called a domestic bond. So bonds that are issued and traded in a specific country denominated in the currency of that country, that's called a domestic bond. Correct? Correct, everyone? Right? So if let's say a UAE company issues bond in Abu Dhabi, in AED, in dirham, then it's a domestic bond in UAE, correct? But if a foreign company, let's say if a US company issues the bond in Abu Dhabi, in AED, so bonds that are issued by entities that are incorporated in another country, in US, for example, and they issue the bond in UAE in dirham, then it's a foreign bond. Everyone with me? Correct? Understood? But now see very interesting thing. What is a Euro bond? Euro bond is a bond issued outside the jurisdiction of any country and can be issued in any currency. So for example, a UAE-based company issues the bond in London market or in UK market, and that too in US dollar. So basically, UAE company is issuing bonds neither in its own country nor in the issuing currency. Yes. So these are bonds issued outside the jurisdiction of any country and can be issued in any currency, including US dollar. Such bonds are called Euro bonds. Euro. Here the word Euro means foreign. It's not related to Europe. Okay. They are denominated, they are named after the currency in which they are denominated. So here I have issued a dollar bond outside US. So it's called a Euro dollar bond. If I issue a yen bond outside Japan, it's called Euro yen. If I issue a rupee bond outside India, it's called Euro rupee bond. Understood? So here the word Euro means outside that country. In the past, like checks were bearer, bonds were also bearer. Bearer bond means those who are the bond holder, they will get the money. Those who have the bond as on that day. Okay. So for example, even if the bond was issued to me, but if I passed it on to someone, or if someone gets it, they can encash the bond like a check. But that was very risky. So now we have registered bond. Registered bond means the bond are, the principal is only paid, the principal coupon is only paid to whosoever the bonds are issued, not to someone else who holds it. That's called registered bond. Same like check issues. Do you remember there was check where you cancel the, on the top you write cancel and you write, you cross check, right? Do you remember that? If you remember those era when you were signing checks. Now, many people don't do that. You have all online transaction, but you used to double cross, cancel, right? The bearer. Bearer means anyone who holds that check, they get it in cash. So that was the case with bonds also. Now, of course, the check will only go, or the bond will only go to the one who is actual owner. Correct? International bonds. See, all these three bonds, domestic, foreign, and Euro bonds, when they are issued in multiple countries, So foreign bonds, global bonds, euro bonds that involve more than one country are called international bond. So if a bond is issued in multiple country, it's an international bonds. Bonds, those bonds which are based on the Sharia compliance, which are called sukuk bonds. Sukuk bonds are Sharia compliant bonds, right, with specific restriction on the payment of interest and on the use of bond proceeds complying with the Islamic law, right? So since riba is haram in Islamic world, so Sharia compliant bonds are called sukuk. Countries like Malaysia, Indonesia are one of the biggest issuers as well as investors in sukuk bonds. Tax structure on the bonds. See, when you invest in the bond, you get returns in two forms: interest and capital gain. Interest is the coupon. Interest, the investors generally pay taxes on the interest based on their ordinary or personal income tax rate, which is very high. For example, in many countries like India, the personal tax can go to as high as 30%. So whatever is my interest, on that I might pay 30% tax. But capital gain tax is generally lower than the interest tax or income tax. Capital gain tax is basically the tax on the gain, that is on the difference between buying and selling price. So if you sold the bond at a higher price, you make capital gain. And this happens when you sell the bond before maturity, because on maturity, you will only get your principal back. So before maturity, if you sell the bond, you might sell the bond at a higher or lower price that might make capital gain or loss. If there is a capital gain, you basically pay capital gains tax. Generally, capital gains tax is lower than the interest tax, and many jurisdictions also allow you the time to time out. For example, compared to short term, long term capital gain tax is very much lower. For example, let's say long term capital gain tax is 10% and short term is 20%. So if you hold the bond for less than 1 year, you pay only 20%. But if you hold the bond for more than 1 year, you pay much lesser, 10% only on the gains. Why is this done? This is done to encourage people to hold bond for a longer period. Got it? Clear? Now, very, very important. Zero coupon bond. Zero coupon bond are also called pure discount bond. Now, tell me guys, if a company is issued a zero coupon bond, let's say for 5 years. So, does the zero coupon bond pay any coupon? As the name suggests, no. Isn't it? So, imagine a zero coupon bond is issued for $90. On maturity, it will pay 100 back. Correct? Now, many jurisdictions, right? See, listen to this carefully, right? Many jurisdictions generate tax liability even when no cash interest is paid. Is there any coupon paid? No, no, no. But many countries have laws which say how much is the gap here? How much is the difference? 10, right? This 10, let's spread it over 5 years. So every year you have a $2 gain. So imagine you're getting interest. Even if you're not getting, imagine you're getting this amount every year, correct? Instead of charging it at the end. See, tax authorities are very smart. They would want you to pay tax earlier, right? So they will, see, listen to this carefully. They will charge you taxes on this $2. You can argue that I didn't get it. Why should I pay? That argument can go on and on, but tax authorities will not agree. So in many countries, there is a general tax liability even when no cash interests are paid, and the discount portion is treated as taxable interest income each year. So this discount divided by the maturity, right? That is treated as an income even if you didn't receive. Understood? And taxed at the normal interest rate tax, interest tax. Clear, everyone? Got it? Right. Check. Let me know. Understood? Let's do the questions, everyone. So I'll do the questions for both the readings now. I've combined them, right? So let's do the questions, and everyone, please participate. Check. Please don't be less energetic. Fixed income is interesting. All the participation and all the energy that you have while you're doing at the beginning will help you in the later form, in the later when I do complicated things. Okay. Which of the following fixed income securities classified as money market? Money market is anything which is issued for less than 1 year. Everyone in the class? Newly issued security that will mature in 1 year? Yes. Security issued 18 months ago that will mature in 6 months. No, that's 24 months. Security issued 6 months that will mature in 1 year. No, that's 18 months. Money market is less than 1 year. Everyone is answering. Very good. Very good. Which of the following bond covenant is considered negative? Negative means something that has restrictions. Okay. So maintenance of collateral is affirmative. No additional debt. Remember, restriction to borrow more. That's called negative covenants. Clear? Every 6 months, a bond pays coupon interest equal to 3% of its par value. See, every 6 months, company pays 3%. So now, even if they pay every 6 months, the coupon is always termed annually. So if they are paying 3% half yearly, annually it is 6%, isn't it? So I would say it's a 6% semi-annual bond, isn't it? This is how we write. Everyone with me? So 6% semi-annual coupon bond. The answer should be C. Everyone in the class? Understood? Very good. Excellent. Restrictions on asset sales and additional borrowings by bond issuer. Restriction on both. What? On asset sales and additional borrowing are best characterized at, even with the, before I showing you options, this is what? Covenants. Which type of covenants? Negative covenants, isn't it? Next, bonds indenture, least likely. Indenture is basically the conditions between the borrower and the lender, right? Least likely include what? Least likely include what? Sources of fund repayment needed, covenants, yes. Identity of the lender, is it required? No, identity of the lender is not required. Borrower you can say, but lender is not needed. Clear? This is from the first reading. Now let's do questions from the second reading. Guys, while doing so, if anyone encounters any complexity, please let me know, okay? Now, second question where we discuss different types of payment structure and coupon structure and so on. Got it? First one, a bond whose periodic payments are all equal, same payments every time. That's called amortizing structure. Amortizing means something which like a mortgage, principal and interest is same. Amortizing. Clear? Question number 2, very important. Let me see how everyone fares on this. Consider a floating rate issue that has a coupon that is reset on January 1st of each year. The coupon is defined as 1 year London Interbank offer rate LIBOR plus 125 basis point. By the way, 125 basis point means 1.25%. Correct? The coupons are paid semi-annually. I'll keep that in mind. 1 year LIBOR is 6.5 on January. Which of the following is semi-annual coupon payment received by the holder? First of all, my coupon payment is 6.5 plus they said 125 basis LIBOR, that is 1.25%. So that is 7.75%. That's my annual coupon. But since it is paid semi-annually, what will I do? I will divide it by 2. So if I do 7.75 divided by 2, I'll get 7.75 divided by 2. It will be 3.875. Everyone with me on this? Check. Clear. B, easy. Yes. A non-amortizing fixed income, non-amortizing means not the mortgage one, is most accurately described as balloon, bullet, or a mortgage bond. Guys, if nothing given, it's always a plain vanilla bond. Plain vanilla bond means a bullet bond where the entire principal is paid at the end. Clear? Which of the following is least likely a form of internal credit enhancement? Now, this we didn't discuss it because it's going to appear at the end. When we do securitization, at that time, this will come. Let me discuss with you what is credit enhancement in short. Okay. The reason I've added some question is because even you might find these questions, but they might get clear when you reach at the end. Okay. Because some of the things are scattered. First of all, when an asset-backed security is issued, it might need credit enhancement to improve its credibility. These credit enhancement can be taken from outside, like insurance or guarantee, like bank guarantee, that will give you sufficient credibility that the bond will not default. And sometimes the companies do those stuff internally. Internally mean they structure the loan in such a manner that the loan becomes less riskier. We'll discuss in length about this when I do securitization. But any enhancement that you get from outside companies, that's called third party or external credit enhancement. Okay, so which of the one is least likely to be internal credit enhancement? Covering the bond issue via surety bond. See, surety bond is like an insurance issued by the bank to you in case if you default. So basically, it's like a bank guarantee. So here the credit enhancement is provided by the external party. That's why it's called external, not internal. The other, including a trans system, structuring the asset pool, these are adjustments within the loan. Therefore, they are called internal credit enhancement. I'll repeat, these internal credit enhancement we will discuss when we do asset-backed securities. In the US, debenture, yes, very interesting thing. See, mostly bonds are global term is bond only. But in US, there is a trend that bond, first of all, apart from US, bond, debenture, debt for all of us is same, except it's just an alternate name in US for debenture, but they call debenture only for those securities which are unsecured. So debenture in US is for unsecured bonds. Globally, whether secured or unsecured, we use the same name, that is bonds. In US, unsecured bonds they have a different name called debentures. Okay, clear? Understood, everyone? Okay, right. See, I'll repeat, except US, globally, secured or unsecured, we call bond only. In exam also, they will only ask you for this issue with US, because only in US debenture is for those which are unsecured. Otherwise, globally, you can say secured, unsecured, we say bond only. Whether you say bond, debenture, it doesn't make any difference. Only US has this issue. Understood? In fact, in many of the countries, they say coupon. In US, they use in accent coupon. Okay, that's okay. Just a joke. Now, the next two readings are based on the fixed income issue. The next reading is based on the fixed income issuance, and it's going to talk more about the fixed income issue market. Then it is going to talk about the market for specific for corporate bonds and government bonds. So are the next three topics. Okay. Let's now talk about fixed income issuance and trading. Many of the terms that we are going to see here are similar to what we already did in equity. Here, I've actually made a table of both the things, that from the issuer point of view and from the investor point of view, which one they will prefer in terms of maturity and in terms of the credit quality. In terms of maturity, in terms of credit quality. Now, before I start going into the table, let me explain you. Less than 1 year short term, 1 to 10 year are called intermediate, and more than 10 year are called long term bonds. Credit quality, default or risk free, means absolutely no risk, right? Slightly above that are investment grade bonds. They have a slight higher risk, but investment grade, we will see in credit rating, all those bonds which go from AAA till triple B negative. Till, you don't need to memorize it right now, but investment grade bonds are from AAA till triple B negative. From AAA to triple B negative. All of these are investment grade bonds. All bonds below triple B negative, that is double B and so on, those are called high yield bonds. Okay, those are called high yield bonds, high yield bond. So default bonds are risk free. Generally, government bonds are only default bonds. So who can issue a default bond? Only government. When these bonds are issued for less than 1 year, we call T-bills, money market. More than 1 year, T-notes, and longer maturity bonds are called T-bonds. T stands for Treasury, US Treasury. Everyone with me? T-bills, less than 1 year, between 1 to 10 years, T-notes, and about 10 years, 30 years, 40 years, and all. So those are T-bonds, right? Companies which are investment grade, which are generally many of the companies with a very high credit rating, like Apple, Microsoft, Google, and so on, right? If they want to issue security for less than 1 year, we are going to see many of the names. They issue repo, repurchase agreement, CP, commercial paper, or asset-backed commercial paper, ABCP. But if they want to issue for 1 to 10 years, they might issue unsecured bonds or asset-backed securities. Why unsecured? See, those who have a high credit rating, they can issue unsecured bonds. Those who do not have a high credit rating, they are risky. They can issue secured bonds. They will, in fact, have to issue secured bonds or leverage loans. Basically, they are leverage loans or secured bonds are more or less the same thing, right? So these are riskier companies. So they have to issue secured. They have to provide collateral. Investment grades need not provide collateral. They can issue unsecured bonds. Correct? Investment grade companies, when they want to issue for 10 years also, they can issue unsecured corporate bonds, unsecured or mortgage-backed securities. Asset-backed securities are generally for 10, 15 years. Mortgages, home loan mortgages are 20, 30, 40 years. So you will see MBS there beyond 10 years. This is basically, general knowledge. You don't have to memorize most of these things. As an investor, which one will I prefer? This, what we saw, is from the issuer's point of view. From the investor, see, issuers decide based on their need, for how long they need the capital and cost. Investors think from risk and return point of view. So they choose from the basis of risk and return and the maturity that they have to invest for. So those who want to invest in risk-free security for less than 1 year, who are these ones? Financial institutions, central bank, money market mutual funds. Financial institutions like banks, central banks, or money market mutual funds. These are the investors who might invest for less than 1 year into risk-free security. Many of them have to invest for regulations. For 1 to 10 years, financial institutions and central banks, I have not taken money market mutual funds because they invest for less than 1 year. Okay. Beyond 10 year also, the same institutions. Do you see banks and central banks dominating the risk-free bond market? Correct. Investment grades are generally bought by pension funds, sovereign wealth fund, and all, but they mostly buy longer term securities. Bond exchange traded fund or asset managers buy 1 to 10 years. And for very short term, generally corporates, they park their short term investments in what? Commercial papers, or they basically invest for a very short period, 1 day, 2 day, to manage their treasury operations. Okay. High yield. High yield, those who are willing to invest in high yield are generally, who are the investors in high yield bond? Hedge funds and distressed debt funds. Remember, high yield bonds are not for less than 1 year. You will not see high yield for less than 1 year or very long period, because they are considered very risky. High yield are generally for intermediate period, and those who are alternative investment avenues like hedge funds, distressed debt funds, private equity, they dominate the high yield bond market. They take the risk in the high yield bonds. Clear? Now, like we have equity indices, we have fixed income indices also, fixed income indexes. Fixed income indexes differ from equity in 3 ways. Otherwise, they are same. How? First of all, equity, all the equities are same. Do equities have life? No, they don't have life. But fixed income are issued for so many different maturity. In fact, a same company can issue multiple bonds of different maturity and different credibility or different credit risk. Therefore, the universe of fixed income is much more diverse and there are more constituents. It's not more standard as equity. It's very much diverse. And see, in equity, when do you rebalance the portfolio? Only when the indexes change or they add or delete the securities. But in bond index, many of the bonds keep on maturing. So automatically you'll have to constantly keep buying, selling. So your turnover is higher in bonds compared to equity. Also, who is the biggest issuer of bonds? Do you think it's corporates or governments? Who's the biggest issuer of the bonds? Corporates or governments? Well, governments are the biggest issuer of the bonds, and therefore the universe of bonds is generally dominated and biased towards government or risk-free bonds. Okay, so it's not as diversified. Clear? Some of the examples which are there in your book, which I've also added for your reference. Aggregate index. Bloomberg has an aggregate index. Bloomberg Barclays aggregate index. Aggregate means it takes multiple varieties. Okay. Some based on geography. JP Morgan emerging market. So they are focused on a specific geography. Some are based on some preferences like ESG. Bloomberg has Bloomberg Barclays, Morgan Stanley Composite Index, MSCI, Euro Corporate Sustainability Index. So these are based on specific theme. The name is the answer. Okay, when they say aggregate, it is very generic. It includes all the varieties. In equity, remember when the equity is issued, it is issued through IPO or private placement. That is either through public offering or private placement. Public offering is when the bond are issued in the market. Private placement is when they are issued to a selected group of investors with high net worth. Within public offering, there are three options. Underwriting and best effort. Everyone is aware about underwriting and best effort. Remember in equity, underwriting, the merchant banker or the investment banker guarantees that they will be able to sell the issue, and for this they basically don't charge any fees. But in best effort, they work on commission and they try their best to sell. So where is the issue guaranteed? In the underwriting. In the best effort, they work on the commission basis. Clear? Also in equity, we discuss shelf registration. Shelf registration is when you want to issue in phases. So shelf registration is done when you don't want to do the entire issue immediately. For example, your project is going to go in phases. So you might have to issue at multiple levels. However, every time you don't have to go to the regulator and file the document again. You can do what? You can issue a single prospectus called the master prospectus for all the issues. For example, I'm going to issue 4 times 250 million. So I don't have to reapply every time. I'll get a master approval or a prospectus. I'll submit it for 250 into 4, that is 1 billion together. And once approved, then I can basically sell the bonds or issue the bond in phases. That's called shelf. You're like your bookshelf. They are issued in phases. Now, these two were also there. For example, underwriting and shelf registration was also there in equity. What is unique in equity is auctions. Yes. Sorry, my mistake. Not in equity. What is unique in bonds is auction. Especially government bonds. When sovereign, that is governments, when they issue bonds to the public, they issue through the central bank. And these bonds are not sold at a fixed price. In fact, bids are being collected from the investors. Generally, investors are institutional investors. This bid collection process is called auction, where the price is discovered based on the bids. Okay. Price is discovered based on the bids. So auction is a market for which categories of bonds? Auction is a market for selling government securities. Government securities are sold through auction. More information of this we will discuss in the next topic also, where we will discuss more about how the auction takes place, how the bidding takes place, what is the cutoff yield, and so on. That's the primary market. Secondary market. Remember, equity secondary market is stock exchange. But where are bonds bought and sold? Are they sold on stock exchange? Those which are previously issued bonds, right? Where are they traded? Bonds are not traded on exchange. They are traded in OTC, over the counter telephonic market. Understood? Bonds therefore have lack of liquidity compared to equities and lack of transparency. Bond is a dealer's market or OTC, over the counter market. Got it? Those who might have seen movies like Wolf of Wall Street, or you might have seen the movie of Margin. What is it called? Margin, of Kevin Spacey and all, where the bond traders, they take the trade on phones. Okay. So the margin call, right? So those are the movies where you will see how the bond trades work. So those are called basically OTC markets on telephonic. Now here, distressed debt. Distressed debts are specifically those debts where the companies are in financial issues, right? Here, suddenly there will be a huge demand if people expect company which is in the distress to turn around. Okay. Basically, distressed debts are issuers that are expected to file for bankruptcy. But if a distressed debt situation may temporarily increase its trading activity. So there might be a very, active market for distressed bonds. If suddenly there is, expectation of either the bond going completely into, bankruptcy, or it might getting turnaround. So distressed debt sometimes increases the trading activity. Okay. That's about the primary and secondary market of the bond. Let us do some questions regarding this reading. So now we will do some questions, right? Let us see. Again, this was completely theoretical. Analyst who evaluates both fixed income and equity indices, right, will find that the turnover for the former means fixed income, to the later will be very high, isn't it? Because the maturities are shorter. So the turnover is higher on fixed income compared to equity. Clear? Ridgeline Company wishes to issue its first bond, which will only be available to high net worth investors, yani, which means not for public, only few. And first issue means primary issue. The underwriter has guaranteed the bond issue price, which following best price is the bond issuance. Private placement, yes. Debut means what? Guys, the word debut means first timer. So yes, because they said first issue, it's a private placement debut issuer. It's not a public offering and neither a shelf registration. Understood? Now, the third one is very, very important. It is based on some logic. Okay. Here you can apply your equity knowledge. The ask price is the price at which the dealer will sell. Correct? Posted by the dealer on older, relatively illiquid bond is quoted as 1065 per bond. Guys, if the ask price is 1065, the bid price will be high or low? High or low? Remember, ask is always greater than bid. Yes, the dealer will sell at a higher price and buy from you at a lower price. So the bid price has to be below 1065. Understood? Everyone in the class, first, this part is clear, right? Now, they said that this bond is older and relatively illiquid. The bid price posted by the dealer on the same bond will most likely be on the older, relatively illiquid bond was C. They have given a comparable bond. Older, relatively illiquid bond is this. Okay. Now, they are saying the bid price posted by the dealer on the same bond will most likely be everyone in the class. See, new bond will have a higher spread. Spread is what? The difference between bid and ask. New bond will have a higher spread or older bond will have a higher spread. New bond will have a higher spread or old bond will have a higher spread. Everyone in the class. Newly issued bonds, correct? They have a lesser spread. Here, the bond is old and illiquid. So its spread will be wider. So first of all, the bid price should be lower. So now there are only two choices, A and B. Of A and B, they haven't given us number, but which one will we choose? Because it's an illiquid, we will choose the one with higher spread. Between 15 and 4, we will choose the one with 15 higher spread. Why? Because it's an older and illiquid bond. Again, why is this question important? Because they didn't give you any number. They made you choose the best. Okay. If it was a new bond, correct? New bond, right? Of course, the bid would be lower, but then I would choose a lower spread. Here, the spread is wider because it's an older illiquid bond. I'll repeat, there was no number here, but you had to make your best guess. Everyone understood why A? Clear? Clear? Next, everyone. Company Jane Reeves manages the travel schedule for an analyst and principal of Orwater Company. The schedule includes several road shows over the next 3 months on behalf of this company that hired OU to bring its debt issue to the marketplace. Lacor's debt issue is described as C. Travel schedule for the analyst. The schedule includes several road shows over the next 3 months. First of all, what type of issue it is? Is it happening for the first time? Everyone in the class? See, this is very interesting. It's happening for the first time, right? Correct. Have they said that this is an older issue? No, no. Now, many people might say, yes, I see many of you are answering shelf issue. Did they say that they are going to issue different parts in all the 3 months? No, they are going to do the marketing. Roadshow means marketing they will do for 3 months. Did they say that we are going to issue first month one part, second month one part, third month one part? No, then it's not shelf issue. It's a trap question. It looks like it's a shelf, but it is not. So if it is not shelf, then I have two choices. Is it a repeat or debut? Have they mentioned that they are issuing again? No. Then I consider this as a debut issue. I know at hindsight, it sounds like a shelf registration, but it is not. Shelf doesn't mean that how long you take for issuing. It means whether the issue is in parts. Don't go with a preset mindset. Just see if that word says so. They did not say that we are going to issue in the next 3 months in 3 parts. Then you would say it's a shelf registration. Otherwise, not. Understood, everyone? Clear? Yes. Next. In explaining aggregate bond indices, guys, what is aggregate? Aggregate is a mix of multiple bonds, right? Is it specific to a particular geography, particular asset class? No, right? A particular, style? No. Aggregate means mix. Got it? Cocktail, I say. In explaining aggregate bond indices to her client, Ashley James references the Bloomberg Barclays aggregate index. Which of the following characteristics described by James to her is most accurate? Bonds included come from many sectors and currencies. There is no minimum size for bond in the index. Is there? See, there is some minimum size, only then they can be a part of index. Highly rated, high yield and unrated bond issuances are all included. Bloomberg Barclays aggregate index. Everyone in the class. First of all, are only highly rated and high yield, and they are saying even unrated. What about low yield or low rated? Are they not included? They might also be included. So C is not the answer. See here, when I say aggregate bond index, C is not the answer. Why? Because it says only highly rated or high yield bonds and unrated bonds. See here, the diversification is not on the basis of yield. The diversification is on the basis of different varieties of issues. Different varieties means it might be of same features but different geography, different industry. Aggregate means a mixture of all the bond indexes. When I say mixture of bond indexes, a mixture of variety of bonds means from different sector, like a broad aggregate equity index like S&P 500. S&P 500 has equities from all the sectors. Same way in bonds also, when I say aggregate index, it is basically bonds from variety of sectors and currencies. That's where the answer is A. It's not that easy, but yes, aggregate bond index refers to this. Understood? If I were a student, I would also be confused between A and C, but the correct answer is A. Clear? Got it? Very interesting. Okay. Now, the next two reading will focus are actually single reading only, but they're divided into 2 parts. Fixed income market for corporate issuers, right? And then we have fixed income market for government issuers. This is where we'll actually finish first 5 readings and first part, which is theoretical, and then the calculation part starts. Okay. So let's start with fixed income market for corporate issuers first. Corporate means commercial companies. Okay. First of all, we are trying to understand that when they need funding, whether for short term or long term, what are the options that they have? This topic is very much related to working capital. Remember, in working capital also, they mentioned us in corporate issuers that what are the resources that the companies have for working capital. So when I say companies need short-term funding, that's basically for working capital. So here the topic is divided into two parts. We will first understand what are the funding options for non-financial, means not bank. And then we will understand what are the options for a bank or financial institution, right? So we'll understand from both the point of view. Okay. And then the third discussion will be completely on repo. Repo is where majority of the discussion will be. Okay. So first, let us understand if a typical company which is non-bank, if they need fund, what are the resources? Non-financial company usually raises external funds. See, first of all, companies always go for internal cash flows. If not, then they go for external funds, right? For investment in short-term assets through financial intermediaries. So non-financial, see, you need to park your daily savings or daily cash inflows temporary somewhere. That's why you are looking for short-term options to park your money, right? This is what is done by a company's treasury team. So what are the options? The options for company, when they want to park their money, they generally go for money market mutual funds, right? For investors, for companies who need money, here we are talking for companies who need the short-term funds, okay? So they can go for external loan financing option, which is basically available to them from the financial institutions. So corporates go for taking short-term loans, or they go for arrangement from the banks or financial institutions. This comes in three forms: uncommitted line of credit, committed line of credit, and revolving credit. Uncommitted, where imagine a bank has given you a credit line, but no commitment. This is very weak form because there is no guaranteed. It's not secured, right? But it is again for short term. Here, because there is no commitment from the bank can actually refuse you if your financial condition deteriorates. However, because there is no commitment, there is low fees, correct? But the better way is committed line of credit. Committed line of credit is a regular line of credit and a stronger form of borrowing compared to uncommitted, where there is no guarantee. Here, the bank gives you an acknowledgement letter, which basically guarantees you indirectly that unsecured loan will be given to you for around 1 year, right? And effective for 364 days and prepayable without penalty. So you can pay them without before time also without any penalty. Again, committed if the bank has given the committed right commitment, so you do not have to reapply for it. You just have to inform the bank. Of course, for such a facility, bank will charge you higher fees. Can a bank refuse to give you credit for short term under the committed line of credit? Can the bank refuse you? Ever in the class? Yes, they can refuse. Okay. It's just that in case if your financial situation has badly deteriorated, banks have the right to refuse. Okay. So committed line, yes, it is committed, but banks can refuse. Between uncommitted and committed, committed is more secure. But committed line of credit is just for one time. What if you constantly need capital? Like what if I need capital every quarterly? So I need a loan which gets automatically renewed every 90 days, right? That's called revolving credit. It is the strongest form of credit where the borrower will borrow repeatedly, right? It can be stretched. This quarterly loan can be stretched for 3 to 5 years. So every quarterly, what will happen? My loan will automatically get renewed. Here, the fees are much higher than the committed line of credit. Understood? So basically, it's an extension of committed line of credit. Is that clear? This is the funding option in short term for a corporate, which is non-financial. That is not a bank. What are the security based? Now, some companies are so large that they don't want to go through the bank. They can directly issue the security in the market. This security that issues large companies like ADNOC or Apple, they don't have to go through a bank to borrow. They can issue directly a security called commercial paper. Commercial paper are bonds issued by corporates for less than 1 year. Okay. If they are issued in Europe, it's called ECP, European Commercial Paper. They are issued by large corporations because they have the credibility in the market that people will subscribe to their short-term securities. Money market sets the rate for CPs. Yes, because it is less than 1 year. It has one of the lowest rate for short-term funds. See, if a company is very well settled and it has a good credit history, then people will subscribe to this money market security. It is cheaper than the bank because then you avoid paying fees to the bank, right? However, here it is also dependent on the market. If the markets are weak, you might not be able to roll over the security. So commercial paper are, you also want commercial paper to be rolling. Means every 90 days, the commercial paper will get rolled over. But what if after 90 days, the market situation is very panicking, like what we had in pandemic or Russian war and so on? In such a situation, there is a high chance your commercial paper might not get rolled over. People might not reinvest. So they do face rollover risk, and hence we also need a backup. So you cannot say that I will only go for security based funding or I'll only go for bank based or loan based funding. You basically need to have both the resources available. So if one doesn't work, there is another option. That's why companies generally have multiple accounts. Clear? Right? Now we will understand what are the funding short term. And guys, when I'm talking funding, until now we are only talking about short term funding. In this entire topic, we are talking about short term funding that is less than 1 year. Okay. Now we'll understand short term funding option for the banks. Now, when banks need money, well, the biggest source for banks is basically the deposits that people do, right? There are various types of deposits that people do, and these include checking accounts, which is also called as a current account, for transaction services where there is no interest paid. So this is virtually like free money for the bank. Also, there are operational deposits, which are large amount of deposits or deposits by customers, right? Basically, they put their money in the bank for a limited period and they earn an interest on it, right? Also, banks basically charge money for various types of services. So this are basically called, what do we call it as, fixed deposits in some countries, or in some countries we call it as time deposits, right? Now, these two are major type of deposit that banks give as a facility to the customers, and they get money from, this is the main source of banks inflow, right? However, banks also issue sort of bonds in the market for short term. These are called certificate of deposits. So when corporates require money for less than 1 year, they issue commercial paper. Governments, when they require money for less than 1 year, they issue T-bills. Same way, when banks need money for less than 1 year, they issue CDs, certificate of deposits. Here they pay interest. They pay interest on the CD like a typical bond, but these are only for less than 1 year. And they can issue these CDs which are non-negotiable or negotiable. Non-negotiable means if I have issued the CD, I am a bank, and if I have issued the CD to you, you cannot sell or transfer it to someone else, right? But negotiable is where you can sell it to someone else in the open market like a typical bond. Which one do you think is more beneficial for the investor? Negotiable or non-negotiable? Negotiable CDs are more beneficial, and therefore negotiable CDs become a very big part of banks' resources. Correct? Now, if that money also isn't sufficient, banks can borrow from the interbank or from the central bank or the federal bank. Interbank funds, funds that are loaned by one bank to another bank. And this can be done through something that we are going to study called through the unsecured borrowing market or lending market called repo. So we are going to understand the repo market, how banks or other institutions borrow from each other. Central banks are where banks can actually, borrow from the central bank. Now, remember, under the open market operation and reserve ratio criteria of the bank, that is called fractional banking. Under that, banks have to keep some proportion of their deposit with the central bank. Correct? Those are the reserves that the banks keep with the central bank. Some banks have excess reserves. So banks with excess reserves lend to the bank that need funds at the central bank funds rate, which is strongly influenced by the central bank's OMO. In US, this is called Fed funds rate. Fed fund, the central bank of US, right? So the excess reserve that are kept with the central bank can be lent or borrowed by the other bank. That's called the Fed funds rate, or in US, it basically general term is central bank's funds rate, or in US, it's called Fed funds rate. Correct? Banks have also the option of securitization through which they will issue asset-backed securities. But for short term, they can issue asset-backed commercial paper. For long term, we say asset-backed securities. For short term, we say asset-backed commercial papers. Now, the interbank fund market, which is huge, it is not only for banks, but it is for all the institutional investors and institutions who want to borrow and lend for short term. This market is called repo, repurchase agreement, repurchase, or repo and reverse repurchase. Okay. So here, as per the agreement, repo is the sale of a security with an agreement to buy it back from the purchaser at an agreed price, which is generally higher than the selling price. So imagine there is a borrower who needs money, correct? Let's say the borrower who needs money, the borrower will sell a security to the dealer. And here the dealer or the borrower can be anyone, right? Including another bank. Okay, so the borrower who needs money will sell the security to the dealer with the commitment that it will buy back from the dealer at a higher price. So imagine I sell, just hypothetically, imagine I sell a security at $100 with a commitment that I will buy it back at 102. So this $2 is nothing but my repo rate. Understood? The difference is called my repo rate. Repo rate. What is repo rate? Repo rate is the interest rate on the repurchase agreement, the difference. So the price at which the dealer will repurchase the security is called repurchase price. And if this entire transaction is for how long? If it is for 1 day, yes, banks need to sometimes borrow for 1 day to meet the criteria of minimum required reserve that they have to keep with the central bank. So if this is done for 1 day, we call overnight repo. If it is more than 1 day, we call term repo. So overnight and term are based on the duration. Okay. Here, the rate at which the borrower will pay to the lender is called repo rate. Correct. But the rate at which the lender will receive is called reverse repo. So what is repo for a borrower is reverse repo for the lender. So reverse repo means the agreement viewed from the counterparty's point of view. So for the borrower, it's repo. For the lender, it is reverse repo. Okay. Now, in this transaction, how many people are involved? Under this transaction, which I have shown on the screen, there are only two parties involved, the borrower and the lender. Correct? So that's called a bilateral repo when only two parties are involved. But when there is a third party involved, like custodian for safety and security, because what if the borrower defaults? So when a third party is involved for security concerns or for clearing, basically custodian or clearing, which can be some other bank, right? That's called a tri-party repo. Tri-party, when there is a custodian or a clearing service involved, then it's a tri-party. Otherwise, it's a bilateral repo. Okay. Now, with respect to repo, there are some calculations which I will discuss in a moment. Before that, let us understand the factors which affect the repo rate. First of all, if the borrower's credit risk is high, will the repo rate be high or low? Everyone in the class, please respond. If the borrower's credit risk is high, will the repo rate be high or low? High or low? High or low? Everyone in the class? It will be high, right? Correct? Now here, remember one thing, that the borrower has sold a security with the commitment that the borrower will buy back. So when I'm giving you a security, it's like a collateral. Okay. This collateral can be anything. It can be treasury securities that I keep with you as a collateral. So here the quality of collateral is also very important. Okay. For example, if the collateral, lower risk of collateral, if the collateral is very safe, like US Treasury bonds, government bonds, then the repo rate will be low. Rate will be low. Also, maturity matters. If the maturity is for less period compared to higher period, the repo rate will be low. Delivery of collateral to the lender is required. See here, I just commit you that I will sell you the security and buy it back. But what if I physically transfer the security to the lender? If this is the provision, then the lender will find it much more safer. So if the delivery is involved of collateral to the lender, then it is more safer. In that case, the repo rate can be low. And what if the security that I'm providing to the lender is very rare? It is in high demand in the market. If such is the case, then the lender will be very happy with the security that I give as a collateral. This security, the lender can utilize it for other margin of the lenders, right? So if the security is very scarce and very scarcely available, and if the borrower is giving me that as a collateral, I'll be very happy. So the repo rate will be low, right? And lower the interest rate of alternative financing in the money market. What if the other options in the money market are also available at a cheaper rate? Then the repo rate will also be low. All of these indicate me what will happen to the repo rate, under what condition it will be high or low. Now, as I said here, see, I've given you a simple calculation where as of now, the security is sold at 100, then it will be bought back at 102, correct? But in reality, whenever a security is sold, right, under the repo, remember you are borrowing here how much? How much is your borrowing in this example? How much is the borrower actually borrowing the amount now in my example? Can I say the borrower is borrowing $100? Correct? Now imagine you have a house of $100 which you need to fund. Correct? Now, if you go to the bank, will the bank provide you entire 100% debt? No. Banks provide you less than the value of home. So basically, banks require some margin. They ask you for a collateral. Okay. Now that collateral's value is higher or the loan amount is higher? Please tell me. Collateral value, that is home value, will be higher or the loan amount given by the bank will be higher? Banks don't give 100% loan of the collateral, right? So generally the collateral value, of course, is higher, correct? Here, the collateral is always greater than 100% of the amount. So the amount that I'm borrowing is $100. So collateral is naturally greater than 100%. So the loan amount plus the extra amount of collateral together is called initial margin. For example, if they say initial margin is 101%, that means $100 is the loan and additional $1, that is $101 worth of collateral you will have to give me. If you want to borrow $100, you'll have to give me $101 worth of collateral. Okay. What if again I say my initial margin is 105%. So if you want $100 of loan, you will have to give me how much? $105 worth of collateral. That extra 5 is like my security in case if you default. Got it? Right? So basically, am I going to get to use 100 or 105? I'll get to use only 100. So the purchase price or the loan amount, interest, and the repurchase, these three things I will show you through an example how to calculate. However, I've put the formula here in a tabular manner. So purchase price is market value of the security divided by initial margin. So for example, let's say the market value of the security is 105 and the initial margin is 105%, then the purchase price is $100. On this loan amount, I'll pay the repo rate for whatever the duration is. And on maturity, the loan amount plus repo is what I will pay back. That is, this is the price at which I will repurchase. Okay. So I will show you all of these. And then for the lender, the initial margin, the extra that the lender has collected is for the safety. So what is the safety or what is the haircut? That safety is called haircut. The shortcut of that formula is 1 minus 1 over initial margin. How is this derived or how to do the calculation of this? I have added an example. So we'll first discuss that. Okay. It's basically from your notes itself. So let's say this. Okay. Let's try to understand through this. A borrower pledges 100 million of security. So my security value is 100 million. This 100 million is the collateral amount. Okay. So this is what I've given. So naturally, can you tell me if my collateral value is 100 million, will I get a loan for 100 or below 100? If the collateral that I've given is worth 100 million, will I get a loan for 100 below or above? Below. Everyone agrees? So definitely the answer has to be either A or B, not C. Am I correct? And they said it's an overnight repo. Overnight means 1 day. 1 day. Repo rate is 4% and initial margin is 101%. So the market value of my collateral is 100 and initial margin is 101%. That is what is called my purchase price of repo or the loan amount that I will get today. See, what is my purchase price or loan amount? It is the market value of collateral that is 100 divided by initial margin. So the present value of the loan or the purchase price is basically 100 divided by 101%. So 100 million divided by 101%, you will get 99,009,09901, right? Am I correct? B should be the answer. Everyone in the class? Have you got B? B? Everyone? Guys, as soon as you get B, my suggestion for everyone is store this value. Store it. Store this. Okay. Now, in the second question, they ask me that assuming 360 days in a year, the interest paid. How much is the interest? See the present value that you got, 99, whatever is the present value. On that 4%, for how much is the duration? 1 day. Overnight is 1 day. That is 1 over 360. So on the value that you have on your screen, into 4% divided by 360, you will get 110, 1, 2, 3, 4, 5, 6 million. If I multiply 11,001. Am I correct? Everyone is getting B? Clear? As soon as you get B, store 2. So the loan amount is 99. The interest on it is 11,000. So on maturity, I will pay back, add both. That is the amount that you would pay back on maturity. Now, this question is not asked here, but if they had asked me what is the repurchase price, you would simply add recall 1 plus recall 2. So I will simply add both. That will be 99.02 something, right? It's not a question asked. I'm just adding it. Everyone is getting that? 99 plus 99,009 plus 11,000. Everyone is getting this? 99,009,901 plus 11,001. You will get 99,002 something million. Correct? If they ask me repurchase price. Got it? Now, that 1% extra that the lender has asked is the margin. So based on this margin, we are asked to calculate the haircut. Now, first of all, I'll show you what is haircut. How it is calculated. It is 1 minus 1 over the margin. That is 101%. Then after calculation, I'll tell you what is the purpose of it. Okay, so if you do 101% inverse minus 1 into 100, you'll get 0.99%. Okay, everyone is getting 0.99%, right? Okay, now what is this haircut? Haircut is the cushion that the lender has in case if the borrower defaults. In case if the borrower defaults, how much proportion the lender will lose? That is this cushion. This cushion is called haircut. This is what I might lose. So this is the buffer. Until this fall, I am secured. If the fall is more than this, then the lender will start losing. Okay. So if the lender is more worried, then the haircut should be bigger. Okay. Here, this is the cushion available to the lender. As of now, this is added in this year, basically haircut and all. Very rarely it has been asked in your entire syllabus. Even in the institute, there is only one question related to it. And I have just added this question, right? Which considers all the parts. In your exam, they might mostly ask you either of this. So I've summarized this and you can practice this question itself. Clear? Everyone? This is very crucial topic. Of all the theory topic, the repo related stuff is very important. Okay. Now, the next topic is simply the shortest of all the topics. Here, there is only one page. We did the fixed income for corporate. Now we will do for government issuers, and then we'll do the question for both. Okay. Now, when I say government issuers, the safest of all is sovereign bonds. They are issued by the central government or the federal government, and they basically are issued by the government to meet their deficit, the fiscal or basically their spending requirements. So the more the sovereign governments issue bond, their fiscal deficit will widen. Okay. So basically, to fund their fiscal deficit is what governments issue sovereign bonds. Now, the sovereign bonds are the safest of all the bonds, and they are generally used to create the yield curve. We are going to see what is yield curve, and the yield curve consists of sovereign bonds of various maturities. But a government also issues sovereign bond, which is safest of all and risk-free. However, for the same maturity, it might issue several bonds. So which bonds will go in the yield curve? The latest issued bonds, that is on the run securities, will be the one which will be displayed in the yield curve. So the yield curve is made up of government securities of different maturities and the recently issued ones. Sovereign bonds are the safest of all. They have the highest credit rating and virtually they are risk-free. Second is non-sovereign government bond. These are issued by states, counties, cities, right? They are typically issued to finance public projects like school, motorways, hospitals, social activities, etc. Airports, these days, many bonds are issued for that. Non-sovereigns are not guaranteed by the national government, but they are still considered high credit rating because they are virtually said to be as safer as them, right? So they trade at a slightly higher yield and lower price compared to a sovereign bonds, but they are still the safest. Okay. Of course, slightly lower than sovereign bonds, but they are also considered to be safer. Third bonds are agency or quasi-government bonds. These are government-sponsored entities. Okay. These are bonds issued by organizations that are set up by national government for performing various functions. They often have both public and private sector characteristics, but they are not actual government entities. They are supported by government. Okay. For example, here ADNOC, Saudi Aramco, right? These are government sponsored entities, not exactly government. You cannot call them government companies, but they are government sponsored entities and they also enjoy high credit ratings. The municipality, the local municipalities, they issue the bond, which are also called municipal bonds. These municipal bonds are issued with two types of obligations, GO and RO. GO are based on general obligations, which are based on the full faith and credit of the issuing government. Basically, they pay from the taxing power of the local city or local municipal. Their credit rating is same as sovereign bonds, right? Because they also have the taxing power, or they can charge the fines and penalties. But RO bond are specific revenue bond, specific project oriented bonds. So here the project's cash flow are dependent on here the bonds cash flows are dependent on the project revenues. Okay. So they are relatively riskier and they function more like a corporate bonds. Then after that, the next in line we have is supranational bonds. Supranational bonds are bond issued by World Bank, IMF, Asian Development Bank, African Development Bank, so on. These are multilateral agencies, and many times these bonds are issued to support some nations or for some not always commercial causes, right? They are also said to be very relatively risk-free, correct? Of this government bonds, sovereign bonds especially, remember I told you government bonds are, do they go for public offering, private placement, or what is the option? How government bonds are issued? They are issued through auction. Auction. Remember we discussed here in the topic where we discussed government bonds are issued through auction. Where is it? Yes, see this part. Correct? Where the bids are invited and price is discovered based on that. Now, based on this, there are some terms that I have added here with respect to with respect to government bonds auction. Okay. So people means institutions will have to bid for government bonds. Those who can actually buy government bonds are not all banks have the power. Only the authorized participants have the they are called the primary dealers. If you remember, they have the power to buy the government bond. They can participate. So they cannot buy anything that they want. They have to bid for it. So everyone bids. There are two types of bids, competitive and non-competitive bids. Competitive bids are at a specific price. If anyone bids at this price, they get a guaranteed allocation. They get a guaranteed allocation. But for all other bids, they are ranked in the order. Ranked in the order means, guys, these people are going to be the bond buyers, right? So who will get the bond allocation? The one who bids at the highest price or lowest price? Ranking will be based on highest price. The one who bids at the highest price will get the bond allocation. But remember, in bonds, high price means low yield. So when they say ranking will be based on highest price, or I can say lowest yield. Lowest yield, they will get the first bidding. So first of all, let's say the government is going for a $10 billion, $100 billion auction. Of that, 50% is, imagine 50% is non-competitive, let's say at a fixed price. So those who bid at that price, they get the 50% allocation guaranteed. For the other 50, you have to put the competitive bids. All these competitive bids are ranked from highest price, that is lowest yield. Now, imagine some of the issues are ranked, the highest price is, let's say, 105, then 104, then 103.5 or 103, etc. So let's say till 105, $30 billion are bid. I need 20 more. See, 50 are, let's say, out of $100 billion, example, 50 are non-competitive. Remaining 50 are competitive. Of those 50, 30 billion have bid for at 100 in price. So they will get a priority. Remaining 15 have bid at 104. Suppose 15 billion bonds are bid at 104 and 5 billion have bid for 103. Now, till this point, all the money that I need is sufficed. So what is the lowest price at which all my bids are fulfilled? Here, the lowest price. The lowest price at which all the bids are filled, that's called my cutoff yield. Cutoff yield. So the issuer will cut off at 103. So whether you bid for 105, 104, 103, 103 is the last price. Anyone who bids below this might not get the issue. Understood, everyone? So first priority goes to whom? First priority, everyone in the class. First priority goes to non-competitive. Then competitive. Within the competitive, the ranking is based on highest price or lowest yield. Highest price wise, you'll get the allocation. And of that, the one who bids at the highest price will get first. And then wherever the issue is sufficed or the issue is completed, that lowest price at which the issue is completed is called cutoff yield. Any price below this is not accepted. Okay. Now, everyone has bid for different prices, right? Till the cutoff point, everyone has bid for different prices. So who will get what price? Naturally, everyone will say, see, you bid for 105, so you pay 105. You bid for 103, you pay 103, right? No, but there are two ways, single price auction and multi-price. In single price auction, everyone, irrespective of whatever price you pay, everyone gets the cutoff price. So everyone gets allocated at cutoff price, single price. That's good for all or bad for all? That's good, right? Because whatever bid you do, we all get the cutoff price, right? But multi-price auction, in this, you pay the price that you bid. Of course, you pay the price that you bid. So here, if the government is very confident that people will buy my bond irrespective, then it will go for multi-price or single price. If the government is very confident that people will anyways, they are anyways going to buy my issue, then it will go for multi-price so that it gets highest amount, right? But if you are worried and if you want everyone to subscribe to your bond, then it's better you go for single price. Okay. This is where the topic completes. I'll do the question, but let me tell you some out of the box information. Of course, the banks, they also form a union or a cartel sort of a thing, and they bid closely. So they bid closely so that they all get the allocation. So they do a lot of games here. Okay. This is just for your help. Of course, they won't blindly bet. So they will also bid closely so that they get the allocation at an affordable price. Got it? Right? Let's see some questions based on this. Okay. So we are going to do questions based on both the topics, the reading number 4, whatever the reading is, and the reading number 5. Okay. Let's do these questions. Very interesting. Okay. These two topics, if you do combine together, you can summarize a lot of things. Compared to a term repurchase, which is for a longer duration, an overnight repurchase is most likely to have, see, lower duration, lower is the risk. So term repurchase overnight will have higher or lower repo rate, lower repo rate, and higher or lower margin, both will be low, right? The margin will also be low and rate will also be low because the maturity is for shorter. The answer is C. Clear, everyone? Next. Reading company has struggled financially over the last several years, but it is hoping to turn around under new leadership. Its credit rating is below investment grade, so it's high yield bond, and it is looking to issue new debt to provide much needed capital. Reading's best option is to issue putable debt, take out leverage loan with prepayment options, issue low yield bond with 20-year maturity. Everyone, please try this. Let me see what answers I get. See, first of all, what are the factors? Company has struggled financially. Okay, so it needs capital. Credit rating is bad, so the yield will be very high. Okay, and it is looking for a new issue because it needs capital. Here, can I issue a putable bond? No, I cannot issue a putable bond because in putable bond, the issuer has the right to dump the bond. And since my credit rating is very low, my financial situation is bad, I cannot take the risk of issuing putable bonds. Now, the second option is take out a leverage loan with prepayment option. Prepayment means like a callable bond. So here, if I issue a callable bond now, correct? What will happen if the interest rate goes down? I can refinance the bond with a lower rate, correct? So that choice is feasible. C, issue a low yield bond with 20-year maturity. Low yield bond with 20-year maturity. See, if you put a higher maturity at a fixed rate, and if the rate goes down, you will be locked in at a higher rate. So it is better you go for a option where you have the feature to call back the bond if the rates go down and the situation becomes better. So amongst all the option, the more feasible option, because looking at the issuer situation, is second option, take out a leverage loan with prepayment option like a callable bond. Everyone understood? Clear? See, low yield bond, no one will buy. Why? Because your company is already risky. So you'll anyways have to attract them at a higher yield. So C is therefore also not a choice. Okay. Reduced rollover risk. Rollover risk means when you roll over the credit bond, right? What if issuers don't subscribe? From standardization is a benefit available to which type of corporate bond issuer? High yield, they face rollover risk. Investment grade and short term. Putable bond, I have got a question. Putable bond is attractive for the investor. For the issuer will, if the investor, I already told you, if the investor sells back the bond, they have the right. What will I do? I need capital for longer term. So I cannot give that right to the investors. So I cannot take the risk of issuing a putable bond because then the issuer can give it back to me at any time and I need capital for long term. So that's the doubt. Coming back to the third question. Reduced rollover risk resulting from standardization is a benefit available to which type of corporate bond issuer who will basically not face rollover risk compared to all high yield, short term or investment grade, who will face the least amount of rollover risk here, everyone. Investment grade are safer bonds, right? Investment grade bonds are easy to roll over, correct? Right, everyone? Fourth, assuming a normal yield curve is upward sloping. Higher yields must be offered by corporate issuer on bonds that mature in 20 years compared with those that mature in 10 years, correct? If the 20-year bond are considered, see, yield curve is upward sloping based on maturity. It doesn't matter whether it's a high yield bond or investment grade bond. All have the maturity risk. So higher the maturity, higher is the yield for all types of bonds. Correct? So answer is A, not only one category of bond, both. The interest rate on the excess reserves borrowed by one bank from another bank. See, banks keep excess reserve with the central bank. So on that, whatever that excess amount that you borrow through the central bank, that is called which interest rate? Very easy. The name itself is the answer. Central bank's fund rate. In US, it's also called Fed funds rate. Not interbank. Is it interbank? Guys, see. Check the notes, check the notes, check the notes, check the notes. See, interbank is when one bank loans to another. But when you borrow from the excess reserves that you've kept with the central bank, that is called central bank's fund rate, which is also called Fed funds rate. Got it? Correct? You're not directly borrowing from another bank. You're actually borrowing from the reserves kept with the central bank. That's why it's called central bank fund or Fed funds rate. Clear? Okay. Yes. Now the next topic also we've done for government issuers. So let's do questions related to that. Related to yields on non-sovereign bonds. Sovereign bonds may be lower because very easy. Because regulatory requirements forcing some financial institution to hold government debt may be the reason. See, many financial institutions like pension and insurance, they have to buy sovereign bonds. So the market for sovereign bond is always liquid. Greater risk associated with their issuer. Sovereign bonds have greater risk. No. Requirement to distribute them in auction format. Not necessarily. So which one of the choice? A. Why A? Because regulatory requirements force many banks and institutions to buy the sovereign bonds and therefore their yields are always low because they always have a demand. Okay. In an auction issue of sovereign bonds, bonds are allocated first to, very interesting, first to who? Non-competitive bids. They get a guaranteed allocation. Remember? Correct? Third, the cutoff yield associated with government bond is described as the yield of the successful competitive bid with. It begins with high price. But then of those, the lowest price or highest yield is the cutoff yield. Not high price. It is the lowest price. Lowest price amongst all, lowest price is the cutoff yield. Clear? Clear? Either you can say lowest price or highest yield. Everyone with me? Understood? Clear? Next. The Federal Reserve of the US will most likely work with primary dealers to enact which of the following transaction. See, central banks do OMO, open market operations, right? This is what they do to conduct the monetary policy, not the fiscal. So A is not the answer. It is either B or C. Okay. Now we will understand this in economics also. We understand expansionary monetary policy means giving more money supply. Contractionary means sucking out money from the economy. So when I say expansionary monetary supply through sale of treasury, see, if the central bank sells treasury to the bank, banks will have to buy and give funds. So that is not expansionary, that is contractionary. Expansionary is when central banks buy the securities from the bank and give them funds. This is how money supply is increased. So expansionary monetary policy means central bank not selling security, but purchasing the security from the bank. All this is part of OMO. Answer is C. Those who answered, great. Fixed income classifications by geography. Which one? Very easy. Emerging market, correct? That is based on geography. Clear, 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 clear. Okay. This is where we completed the first 5 readings, which are theoretical, except slight calculation of repo, for which we did repo related calculation. Now, the remaining part of the topic are based on valuation. Now actually starts the core calculation. There are a variety of calculations. You have valuation, then you have risk, then you have credit, part related to credit risk, which is theoretical, and then you have securitization. A very massive topic, but we'll step by step cover everything. Clear? Okay. Yes. Thank you.